Okay, well, let's start. It's now 8:05, and we'll get cracking with the webinar. Thank you for all of you that have taken time out of your busy schedules to join the webinar tonight. My name's Richard Lowe. I'm the CEO and founder of Turn-Keyinvestments. Turn-Keyinvestments is a company that helps clients grow their wealth via a wide variety of real estate related investments. They may be both traditional, as in buy-to-let investments where you're buying and owning a physical property, collecting a rent, and over the long term, hoping to get capital appreciation. But I also have lots of different other real estate related investments. In fact, one of those I'm going to be sharing with you tonight. And over the years, I've grown a wide portfolio of different kinds of traditional and alternative investments in many different countries around the world. And I'd like to think that if you like real estate as part of your overall investment portfolio, then 9 times out of 10, I'll have something for you. It really is just a matter of understanding what your investment goals are, your risk appetite, your time horizons, and then aligning the right kind of investment with those investment goals. So again, if tonight doesn't happen to be the kind of investment you're looking for, I hope that we can form a relationship if I haven't met you already, and we can sit down and understand what your investment goals are and see if there is something that would be aligned to your goals. So tonight, we have a webinar on a very interesting asset class, UK social housing. And it's an asset class that many people in this part of the world haven't heard of. And I'm going to be sharing during the first half of the presentation really an overview so that people do get a better understanding of what social housing is about and the profound impact that it has on society in the UK. And then the second half of the webinar will really be introducing you to one of the developers that I work with who specialize particularly in UK social housing and have been in this space for a long time, building these kind of properties on behalf of the government. So that will be the roadmap for the presentation today. Before we actually get started, we will be having a Q&A towards the end, and you should be able to see a chat box towards your bottom right-hand corner, especially if you're using a laptop to listen in tonight. What I'd just like to ask is, first of all, can you find that chat box? And if you can you just put into that chat box whether you are familiar with social housing in the UK or not? Just put a Y if you have some familiarity with UK social housing, and an N in the chat box if really you have very little or no understanding. So see if you can find the chat box. It'll be useful in the towards the end when we do the Q&A as well. So it just gives me a sense of the audience tonight to kind of garner how many people are familiar with UK social housing. So if you could just put a yes or a no in the chat box. I'm just going to have a quick look as people are putting yeses or Ys and Ns in there to get a sense of where we are. So I've got about 5 or 6 people. Do see if you can find that chat box and just put your comment in, either N for no or Y for yes. I'll just pause again just for a moment, just watching there. Maybe as people are just putting in their answers, I'm based here in Singapore. I've lived in Singapore for 30 years. Prior to that, I was in Hong Kong for 2 years. So I've now lived more than half my life here in Asia. As you can probably tell from my accent, I'm from the UK. In fact, I was born in England. I went to university up in the north of England, at Newcastle. And in my earlier career in Asia, I was very much involved with launching some of the big health club chains like California Fitness, Fitness First, Pure Yoga. I had my own small chain of fitness, nutrition, and weight management centers. And then a good friend of mine who was also in the in the fitness industry got into real estate, and he needed somebody to head up operations in Singapore. And 18 years ago, I transferred into finance developer finance and real estate investment. So that's a little bit about my background. Okay, thank you very much for those people who put the comment into the chat box. At least you know where the chat box is for questions a little bit later. For the people that are dialing in from Singapore, which I think is the majority just at the moment, one of the areas that people confuse with social housing, affordable housing, is HDB, or the Housing Development Board here in Singapore, which effectively is a government entity, and they are a developer, and they develop affordable housing for Singaporeans and provide various grants to help Singaporeans get onto the housing ladder. And so I would really term the HDB as a government developer providing affordable homes so that the vast majority of Singaporeans can get onto the housing ladder. We'll see that social housing is not the same. The UK does not have a government department that is a developer. They basically rely on using the developments to private developers. So there is no equivalent. Now, there is things called affordable housing, which perhaps is closer to what HDB does, but again, it's still delivered by private developers. And social housing, where I'll go into a little bit more detail of the definition of what we call social housing, as well as social housing and supported living. So look, let's get started, and we'll start sort of first of all at a high level and trying to get an understanding of some of the differences of what we call a welfare state. And the UK is referred to often as a welfare state, as well as many other countries in Europe. And typically in a welfare state, taxes are higher compared with places like Singapore and other Asian countries. But in return for paying higher taxes, the government provides additional services. Now, if you're a resident in the UK, we have something called the National Health Service, or the NHS for short, and you can get access to free healthcare. It might mean sometimes being on a wait list for a long time, but you do have access to free healthcare. You also have access to free education, and believe it or not, it's even free access to housing to people that do qualify for that free housing. And when I do webinars and seminars on this topic around Asia, whereby it's very common that the extended family is the one is providing a safety net for people to have housing. So people often live in extended families with 3 or 4 generations under the same roof. Unfortunately, that isn't the case in many Western countries. And if somebody can't afford a house and they qualify, they can get free housing. Now, social housing isn't something that has been dreamt up by the latest government. Social housing has been around for almost 100 years now. So irrespective of which government's been in power, social housing is very much part of the fabric of the housing industry in the UK. Now, in 2017, the government introduced what we call the Homelessness Reduction Act. And if somebody is in jeopardy of losing their home, that is, they can no longer afford to pay the rent, or they can't service their mortgage, they can go to their local government, or a town, in Singapore jargon, a town council, and within 57 days of becoming homeless, they actually have a right to have a roof over their head. Now, there may not be a property available right away, but they will be able to ask for temporary accommodation, which I'll go into in more detail in just a moment. So effectively, approved individuals or families can qualify for free housing in the UK. One of the challenges in the UK is that there is a massive and chronic shortage of property, both in the private sector as well as in the public social housing sector. It's estimated that the total number of properties that are needed in both the public and private sector is approximately 300,000 every single year. And Recent data has shown that the average over the last 30 years has been somewhere between about 160 to 170,000 properties on average over 30 years delivered per annum, which is way below the 300,000 target. And when it comes to affordable and social housing, out of that 300,000 per annum, it's estimated that 145,000 is needed every single year to keep up with the demand for social housing. Now, we can see under the next point that in 2023 and 2024, only 9,500 new social housing homes were actually delivered, which is obviously a far cry from the 145,000 that's needed. Because of the lack of supply, last year we saw an increase of 140,000 homeless people as well. And so unfortunately, the situation is worse rather than getting better. Now, at the moment, it's estimated that it's just over 1.3 million households that are on an official waiting list. And those people on the waiting list for permanent accommodation are placed into temporary accommodation. Temporary accommodation in the UK is typically hotels, serviced apartments, Airbnb, and hostels. And in the north of England, it's estimated that the nightly cost to the local government of housing somebody in a hotel is about 5 to 6 times the cost of housing somebody in a purpose-built and far more suitable apartment or house. In fact, it's costing an estimated 2.4 billion last year on the temporary accommodation costs, which could have been used for either renting or building additional, more suitable long-term accommodation than housing families in hotels. So this graph actually shows the stark contrast of affordable and social housing. We can see on the top yellow line that the demand is gradually increasing. In 2024, it's, as I said, it's estimated at about 1.3 million households are needed, because that's how many are on the wait list. Now, that doesn't even take into consideration the homeless people that are not even on that waiting list. And when we see the more orange line, really orange line down at the bottom, this is a combination of both affordable and social housing, which is gradually increasing, but we can see as last year has reached about 200,000. So there is just a huge chasm between the number of houses that are needed and the number of houses that are actually being delivered. Now, the UK government has been ramping up funding for social housing. In fact, this year, they rolled out a 10-year plan pledging 39 billion for social housing, which is the largest long-term commitment in a generation. So it's a very positive note, but yet still a far cry from the amount that's required to be able to solve this situation. Now, Labour government has promised to deliver 1.5 million new private and social homes over the next 5 years. That was one of their pledges before coming into power last year. The challenge is that's delivering 300,000 properties a year, and we know from previous data that the average over the last 30 years is between about 160 to 170,000 units. On top of that, we know that the number of new planning applications has actually decreased rather than increased, and the planning applications is really the start of the developer pipeline. So if the number of applications has actually gone down, it's more likely that the number of properties that are going to be delivered over the next few years is going to go down rather than up. And so I have a big question mark on whether they are going to be able to deliver the 1.5 million that they promised. So it really is going to be a huge effort, both on public and private partnerships, to be able to deliver the number of properties that the UK needs. Now, it is estimated that 10 billion is needed per year to address social housing shortage. And so even with the recent pledge of 39 million over the next 10 years, again, there's still a huge deficit between what is needed each year and what is being delivered. Now, housing associations, in layman's terms, and I'll go into this in a bit more detail soon, housing associations are, in layman's terms, the property management arm of the local government. Now, these housing associations have an estimated and combined ownership or tenancy of about 78 billion worth of social housing properties. And with the growth that is required, it's forecast that the amount that they will be owning or renting is only going to increase significantly because of the huge demand of social housing properties that are needed. So here we see a bar chart showing the increase in government funding over recent years. So the good news is more funding is being allocated by the government, but it's still woefully short of what's needed. And so it is definitely required that private funding is also required in addition to the government public funding. Historically, this asset class has been dominated by institutional investors, UK social housing REITs, UK social housing funds, and recent examples, CK Asset Management. For those of you who are familiar, this is actually a company that is owned by Li Ka-shing from Hong Kong. He bought a housing association called Civitas Social Housing PLC in June in 2023 for 485 million. Soon afterwards, he continued to acquire other housing associations and now has a portfolio that's estimated to be over 3 billion. Other organizations, Legal & General, a very large insurance company, own a 1 billion portfolio. M&G Investments manages a 5 billion portfolio. And other major institutions like Blackstone, Schroders, Goldman Sachs have also invested into this asset class because for those who own the physical asset, these assets basically provide a very stable, inflation-hedged long-term income and very predictable as well. So many of these investment firms do want to have, as part of their investment portfolio, this very stable, predictable, inflation-hedged income. So what exactly is social housing and supported living? Let's go through a few definitions. So if I use the term social housing purely on its own, this is for individuals or families that qualify for free housing paid by the government. But if I add on the tag of supported living, so social housing and supported living, this provides vulnerable people with not just a free home, but specialized social or healthcare services. So in the UK, there are many vulnerable individuals and families that need additional help over and above just having a roof over their head. So this may incorporate orphan children. It may be elderly people with no other family to support them. It could be physically or mentally handicapped. It might be mothers and children escaping domestic violence. It may be war veterans with psychological support requirements, and the list goes on. There are many vulnerable people, and they need not only a roof over their head, but they may need some specialist social or healthcare services in addition to the property itself. In the UK, we often refer to as a local government, as a local authority. Those are pretty much interchangeable, or a local council. So if you hear me use the term local authority, this is like a local government or a local council. In Singapore jargon, it would be like a town council. Now, I mentioned the housing association plays a pivotal part, and each local authority will be working with multiple housing associations, and those housing associations basically look after the social housing on behalf of the local authority. They are regulated organizations, but they play a multifaceted role. They could be either the tenant to the property, or they might be the owner of the property. And for tonight's webinar, they will be on the side of being the owner of the property. But they also have full responsibility for property management, repairs, utility, void periods, and they may provide support or care services to vulnerable people who are living in the property as well. So basically, they really take care of everything, and they can be either the owner of the property or the tenant as well. Now, the next slide, I'm actually going to play a video clip from an ITV news story. And the reason I'm including this into the webinar tonight is it's going to showcase just one profile of people, which are people that are having mental health challenges, people with autism. And for people that may be suffering and having to stay in mental health hospitals, which is paid for by the National Health Service, the NHS, it shows the story whereby many people who could be living in social housing with a lighter level of support, but being allowed to integrate into the community, have not been able to do so because of the lack of the social housing and supported living homes. So they've ended up having to stay in these mental institutions literally for years, costing the taxpayer almost £500 million every single year. So I'm going to show you this video clip to really try and personalize just one profile of people. So it hits home that this is a profound investment that is around social housing, but it is having massive impact on individuals' lives. So let's watch some of the video, and hopefully it will really bring to light the impact it's having on people's lives.
An ITV News investigation can reveal the NHS in England is spending more than £500 million a year, keeping more than 2,000 people with learning disabilities and those who are autistic locked up in hospitals. We can also report almost half of those patients don't need to be in hospital at all. But a lack of funding to give them a life in the community means they remain locked up indefinitely. The government had promised to cut the numbers of those locked up in half by 1st of April this year, but we can now reveal that they will miss that target and they are 6 years behind schedule, as Peter Smith reports.
For 10 years now, Sarah's daughter has been kept locked up in hospital. We're choosing not to show her face or name her. It's not that Sarah's daughter has done anything wrong. She isn't serving any kind of sentence. She was born with a learning disability, and it's now a 2-hour drive for her elderly parents just to see her, and visitations are restricted.
She's being punished for being herself.
For having a disability?
For having disability.
When Sarah's daughter first went into hospital, it's because she needed help. Now, she can't get out. In fact, she was clinically cleared for release 2 years ago.
You're in hospital to get better. You're not in hospital to be kept. It can't be cured. She needs support in the right environment, and the hospital is not the right environment.
Her daughter just needs a suitable place to go and some carers to support her. Then she could live freely in the community, close to family. But our society is not providing that. Lack of funds, Sarah is told. So her daughter remains locked up indefinitely.
I don't know what goes on. I'm not known for 10 years what's actually going on behind those gates. If somewhere isn't found for her very, very soon, she's going to regress and remain in there for the rest of her life. God forbid.
The system that is keeping her unnecessarily
Yes.
is also breaking her.
Yes.
And that would mean a lifetime potential with no release date in this secure hospital.
And the financial costs behind that must be enormous.
We have now investigated the money being spent on this, and Sarah is right. There are more than 2,000 with learning disabilities and autistic people currently locked up in hospitals across England. From data ITV News has obtained, we can report it costs more than £500 million for just 1 year. The NHS pays for this, and on average, current patients are being kept locked up for almost 5 years. Following an NHS England review last year, we reported almost half don't need to be in hospital at all. Based on our Freedom of Information requests, that would mean £18 million a month is spent from the NHS budget, locking people up whose needs could be met in the community.
We have a huge waste of public money going on buying the wrong kind of care, institutionalising people, placing them in a position where they're subject to restrictive practices like being over-medicated, kept in isolation, subject to physical restraint, where people are left damaged and traumatised.
So I think that kind of video really brings to home the dire need for additional social housing and the impact that it can potentially have on individuals and families' lives. So let's move on. Here I'm showing what is the flow of government funding and how the money moves. So effectively, central government, it's actually the Department of Work and Pensions, provides the funding to an organisation called Homes England. Now, Homes England is there to provide grants and to facilitate and help deliver social housing. Housing associations and local authorities each year need to submit a budget and then will receive funding from Homes England, and they will work with an approved panel of developers, and those developers in turn will receive that funding, which will help them to purchase the land for the construction of the property and pre-agreed purchase price of those properties. So we can see how the money flows from central government to Homes England, the housing associations and local authorities, and the approved panel of developers that the local authority works with. Now let's look at how they appoint the developers. So a local authority and housing associations, again, will have to submit their budget. They will have KPIs that they will have to hit in terms of delivering social housing units in their region. What they'll be doing is speaking with their panel of developers. They will agree contracts in advance before any work is done on the land acquisition, the construction, and the pre-agreed purchase price. Once those contracts are signed, the developer would be then appointed, who will build and deliver the property on time and within the agreed budget. And then when the developer gets on site, basically they will receive funding. The developer will buy the land, but then sell it back to the local authority for a small profit. Once the construction starts, the developer that I'll be showcasing later basically bills the local authority on a monthly basis for the cost of construction plus a 30% profit margin. And once the property is built and completed, the developer will hand over the keys to the housing association, who can then start filling that house with the profile of people that it was built for. So let's now move into the second half of the webinar tonight, and I'm now going to focus in on the Oldley Group, a developer that specialises in particular in social housing and supported living in the northwest of England, so in the sort of Liverpool and Manchester area. So the Oldley Group's background, it's a family-owned business between Kevin Corish, who's the CEO and chairman, and his son, Bobby Corish. They have 25 years of real estate experience, or at least Kevin does. Bobby's certainly younger, but Kevin, with the wealth of experience he has, gives a great deal of confidence to the parties that he's working with. And the Oldley Group was founded as a brand and a business in 2019. So the Oldley Group track record, at the moment, their combined gross domestic value pipeline is 1.19 billion. And what we mean by a gross domestic value pipeline is if you were basically selling all of the properties that they're in the process of building at today's prices, the total combined value of those developments in the pipeline is worth an estimated 1.19 billion pounds. Now, this is a combination of both social housing properties that they're developing, as well as properties in the private sector. Within the social housing development department, they have completed and development pipeline of a gross domestic value at 280 million. So a significant portfolio of properties. The forecasted post-tax profits based on that pipeline between 2023 and 2028 is 49 million. And they presently have 13 secured developments, of which 5 have been completed and 5 are in the construction phase. So on the left, the 2 smaller pictures are 2 properties that have been completed. They're in the town of Warrington. For those of you familiar with the UK, Warrington's a town really halfway between Liverpool and Manchester. The top left one, which is called the Vicarage, was completed in November 2024, and the one below, called Townhill, was completed in May 2025. And you can see actually both of the same properties on the right-hand side that I visited both of those when I was in the UK back in May, June of this year, just doing some of my additional due diligence and seeing that those developments that were in their pipeline coming to completion had actually completed. The Oldley Group have won many different awards across national awards in the UK. One of them being the Global Recognition Awards for 2025 for affordable housing, the SME News UK Enterprise 2025 Best Social Housing Development, finalists in several others. In fact, they've just been nominated, if you look at the logo in the bottom of this slide, the Inside Housing Development Awards. They are a finalist. We'll see if they actually win the award, and that's going to take place on the 25th of November of this year. So we can see that they're already gathering lots of awards and recognition for the quality of their build in the social housing space. So just to go through a little bit more about the unique business model of the Oldley Group, which really impressed me when I first started to get to know about them. Basically, what they have done is build relationships up with local authorities and then become one of the approved developers on the local authorities panel, particularly local authorities up in the northwest of England. Now, they go to the local authorities and ask them where are the towns and cities with the greatest social housing needs. The local authority tells them where those are. They go out to those towns and cities and they look for land, typically with planning permission, and they then acquire that land. They have an agreement with the local authority that the local authority will buy that land off them for a small profit. Once the land has got all the submissions and architectural drawings approved, they will commence with the construction, and the contract will be delivered and awarded to the Oldley Group to build. As I mentioned earlier, the unique model here is that they, as soon as they start construction, each month they will invoice the local authority for the cost of the build plus a 30% profit margin. And then when they finish the development, they'll hand the keys over to the housing association. So if you think about it, this development model effectively means that the Oldley Group, before they invest a penny, have already got the contracts in place, pre-approved to sell the land at a profit margin back to the local authority. They have the contract signed for the construction, and they have a pre-agreement on what the final purchase price will be. So they go into this before putting a penny down, knowing all the figures and knowing that there is a guaranteed exit to the housing association local authority, irrespective of market conditions. Unlike a private developer who would be acquiring the land, developing the land, typically selling the units in the open market. But if the open market sentiment changes and sales slow down, and maybe interest rates go up, what we have seen with that combination is suddenly the developer may not be making the same kind of profit margins. They may not be selling the number of units they expected, and they face hard times, and in worst cases may even go bankrupt. So when we look at this model, even if the economy turns in a negative direction, it actually means that more people would need social housing. So there's an even greater demand. At the bottom right, we see here some of the names of the housing associations that the Alderley Group work with: Taurus, Onward, Housing 21. Between them, they actually either manage tenants as tenants, or own literally hundreds of thousands of properties, particularly in the Northwest. And so they work with very established housing associations, which, as I mentioned before, are regulated and registered entities. So why invest in social housing? Well, we've already established there is a chronic undersupply with 1.3 million households on the wait list. The primary funding is actually coming from the government, and we can see with the Alderley Group, they invoice the local authority for the purchase of the land, as well as the construction and the final purchase price. It's a very low risk development model, as the developer only commits to the project once the government contracts are signed. They have a guaranteed exit to the housing association, which mitigates fluctuations in the open market, which a private a developer in the private sector would be exposed to. And as I mentioned, it's a defensive asset class. When the economy is down, more people need social housing. So as part of an overall investment portfolio, having certain assets within your portfolio that are counter-cyclical to the economy can be a very defensive mechanism. And ultimately, it's providing excellent returns and having a profound positive impact on society as well. So let's go into the actual nuts and bolts of the investment. The structure of this investment is effectively what we call a loan note or bond. In simple terms, you are lending money to the Alderley Group, who in return will pay an interest coupon rate of between 10 to 14% per annum, depending on how much you invest. The total length of the term is just 18 months. Now, the investments start from £10,000 or 20,000 Singapore dollars. So the entry level is certainly a lot lower than actually investing and owning a property. Investments can also be done in Sing dollars, pound sterling, US dollars, euros, yen, and in fact, there is actually just been released Australian dollars as well. Now, for those of you who are on the call again tonight from Singapore, that means that you can invest in your home or base currency of Singapore dollars. Your coupon interest is paid in Singapore dollars, and your capital is repaid back in Singapore dollars, which basically means you're not exposed to any FX risk. And if it happens that one of the other currencies is your base currency, then again, you're not exposing yourself to any FX risk whatsoever. Investment returns are also tax-free for Singaporean and Malaysian investors. It may be that there are other countries, but I'm not a tax expert by any means and don't know all of the tax laws in all of the countries around the world. But for the majority of people on the call tonight who are from Singapore and Malaysia, you can't get more tax efficient than that. Also, there are no entry fees, management fees, or exit fees. So 100% of your funds goes into the investment and none of them are taxed. The application process is very quick and efficient. It typically takes 1 week or less to turn around the investment and have your investment live, unlike going through a property transaction and conveyancing process and possibly a mortgage application, which could take 2, 3, 4 months to get completed. So here I've got some benchmark comparisons with other investments. I have to admit they are more Singapore centric, but in a balanced investment portfolio, you might have a basket of many of these kind of investments. And when we look, I appreciate there are different levels of risk factors to these investments. But when we look at things like 6-month T-bills at the moment, giving about a 1.4%, 3-month fixed deposits somewhat similar at 1.4%, Singapore saving bonds at about 2.1%, CPF between 2.5 to 4%, depending on which account it's in, and other factors as well. Singapore investment grade bonds 3 to 4%, Singapore REITs 5 to 6%, Singapore Straits times index giving in and around the 5 to 7% mark, and S&P 500 circa 10.6. So we can see with the Audley investment giving somewhere between 10 to 14%, it is giving a very attractive rate of return. Now, it is a secured investment, and in effect, when you're lending money to the Audley Group, your funds are secured by way of a first charge on the developer's assets in favor of you, the investors. Now, what do I mean by that? If I compare it with yourselves buying your own personal property, if you go to the bank and ask for a loan, they will assess you as a client and make sure that they feel that you're credit worthy. They will do a valuation on the property, and if they're happy to lend money to you, they will do so and maybe offer you a 70-75% loan to value. But for the bank to protect their loan and liability, they will take a first charge on the property. Now, as long as you service your mortgage, then there'll be no problems. But if 3 or 4 months go by and you've defaulted on servicing your mortgage, the bank has the legal right to step in, repossess the property, and sell it off to recover their loan. And in a somewhat similar way, this is how this structure works. But in this case, there is a third party called the Blue Water Trustees. They're a security trustee that hold the title deeds and have a first charge on the developer's assets in favor of the investors. So again, in an unlikely scenario that a default occurred, Blue Water Trustees will repossess the Audley Group's assets. They would appoint administrators, and those administrators would then take some initial time to assess the Audley Group business. And depending on the assessment, they might say, well, actually the best option would be to appoint another developer to complete off the properties and sell them off, in which case there may have been a default, but there may well be a vote to say, okay, it looks like we can get this back on track in 3 to 6 months, appointing another developer, and that would be the best course of action. Alternatively, it might be that it's decided that selling off the assets would be the best course of action than to recover the investor's capital. So here I've actually done a screenshot of the charge, which is registered with Companies House. Now, in the UK, Companies House is the government department where all companies are registered. Here in Singapore, it is ACRA. And we can see here that the company that has a charge against it is the Audley Group 2019 Limited, which is where all of the social housing properties are under. and it's in favour of Blue Water Trustees Limited. So again, you can see there the actual charge. Now, in addition to the first charge in favour of the investors as a form of security, other risk management things have been put in place. So we have something called the absence of senior debt. What that means is there's no other bank financing involved. The Alderley Group don't need it because ultimately they're getting paid and financed mostly through the government. They raise money through the bonds because that helps with some of the cash flow to help initially purchase the land, as well as professional and architect fees. So with no senior debt, effectively the investors are ranked first if it were to go into a default. Whereas if there was senior bank debt financing as part of it, and there was still investors who had money in the investment loan note, the bank would insist on having a first charge, and in which case then the investors would have a lower ranking. Probably they would be second in line. So I want to make this clear that unlike other developers where they may bring in senior debt and the ranking of the investors goes down, in this case, no senior debt is used. So the ranking of the investors always stays as the first rank if a default were to occur. The Alderley Group also takes out various insurance policies. So, you know, if a fire were to break out and burn down the development during its build phase, then the insurance policies would be able to be claimed to pay for the reinstatement and building. There are extension timelines, typically 6 months, and these are in place because sometimes unforeseen factors can delay a project, particularly if you have very bad weather disruptions in the winter with extended periods of ice and snow. So when we look at the track record of the loan notes that have been issued by the Alderley Group, they've just launched the number 5 or Series 5 loan note where they're raising £20 million. Prior to that, they'd launched Series 1 to 4. All of those have now been fully subscribed. They have raised approximately 30 million to date and no defaults. So, practicalities, if you were interested to invest, how would you go about it? Well, you'd ask me for an application form and complete that. It only takes 10-15 minutes, together with supporting documents, which would be a proof of ID and proof of address. I would vet through the application, and if it looks like everything's in order, I'd forward it to the Alderley Group for their assessment. The Alderley Group will then confirm if your application is approved within 1 to 2 days. And if it is approved, they'll send you an email of where to transfer the funds to the Alderley Group. And typically within 1 week, you'll receive a full welcome pack with your certificate and documentation. And as I mentioned, the total application can be done in less than 1 week. So it's very, very time efficient between the time of starting the application and the investment going live, with yourself accruing interest on a daily basis. So in summary, basically, this investment, I believe, is working in a development model which is a low risk model, as all the contracts are agreed upfront. There's a guaranteed exit, and you're working with a developer that has over 25 years of experience. The returns are very attractive, between 10 to 14% fixed annualized returns. The length of the term is 18 months. Investors have a first charge security over the developer's assets, which is administered by Blue Water Security Trustee. You can invest in multiple currencies: Singapore dollar, pound sterling, US dollar, euros, yen, and Australian dollars. So you can choose the currency of your choice. And if one of those is your base currency, you're not exposing yourself to any FX risk. It's extremely tax efficient, especially for those of you who are from Singapore or Malaysia. There are no taxes charged on this. And it's very time efficient. As I mentioned, it takes typically 1 week for the application to be processed and your investment to go live. So if you are looking for an investment which is very much hands-off, but also a very attractive investment, what I potentially believe is a low-risk investment, but also having a profound positive impact on vulnerable people's lives, then it is a truly amazing opportunity to invest with impact. So that brings me to the end of the presentation. Thank you very much for attending and listening in. What I would like to do is open up the opportunity for questions. And for those of you who already know where the chat box is, it should appear on most of your screens towards the bottom right-hand side. And if you would like to put in a question, I'll do my very best to be able to answer. So please go ahead, put the questions in, and I'll be delighted to see if I can answer. Please don't be shy. A question that you may have may well be something that a question that somebody else has, but they are a bit too shy to ask. So, okay. First question from Michael. Can you share the investment FD memo for the Alderley Group? Sorry, can you just expand FD? Sometimes that refers to a fixed deposit, but can you just expand on what you mean by FD, Michael? I have marketing materials, which are brochures, information memorandum, the term sheet, frequently asked questions. So we can definitely share that with both yourself and those people that have already attended. Yes. So when you refer to like the bond covenant, that's really the information memorandum. So yes, all the contractual information can be shared with you as well. So, Kim Yin, thank you. Why raise funds through bonds when they can possibly borrow cheaper from financial institutions? So let's say financial institutions are typically banks, and certainly developers do typically use banks for funding, but the majority of the funding actually comes through the government, which is effectively costing them nothing. The reason they are raising funds in the early stage to get the developments going is very often banks are averse to risk, and typically banks don't provide lending at an early stage of a development. And if they do, they very often will take a long time to do their due diligence before they will actually lend. And unfortunately, by the time they've done their due diligence, it can easily be 3 to 6 months that they actually provide the loan, albeit with no guarantee. And very often the land parcel has gone by then. So by raising funds through the bonds, it does give the Alderley Group cash reserves so that when they find a piece of land, they can move quickly and acquire that land. So yes, the cost of funding for that portion is more expensive, but it does mean that they can move more quickly and access those pieces of land. Esther, you asked a question. Are there max amount we could invest, and what is the deadline for this? Well, they've just issued loan note 5. That's a £20 million raise. It can be done in all the different currencies, so that's probably about 34 million Singapore dollars. So the maximum would be the amount that they are raising. and you can invest, however much you're comfortable to do so. The deadline is basically when it gets fully subscribed. So it's at the moment it's an open end, it's not closed funds. As soon as you invest and your funds hit the developer's account, on that day the 18-month term will start, and you'll start accruing interest from that day. How to invest directly in social housing? Is this an opportunity? Yes. So if you heard me right at the beginning, depending on when you came in, I do work with other developers whereby if you wish to actually invest and own the property, I have other developers that I work with. Typically, properties start from £75,000 going up to multi-million-pound portfolios and everything in between. Starting net yields can be from 9%, and interestingly, the yields are with leases with a housing association, often 10 to 25-year tenancy agreements with no break clause, whereby the rent is adjusted upwards every year based on inflation. So, Michael, yes, there are different ways to access investing into social housing, and I can offer both a loan structure where I've shared tonight, or direct access to actually owning yourself the physical asset and having a tenancy agreement with the housing association, which receives the rent from the government in that case. What's the total national value principal of this fixed income bond? Oh, notional value, principal. I think what you're referring to is, how much are they raising? It's £20 million in this tranche. In the 4 prior bonds that they raised, they've now raised a total of about 30 million. The first 2 bonds, most of the investors have come to the end of their term, so those investors have either been paid out, or many of them have rolled over their investment into series 3 or 4. Sean, you ask a question here. What is there to prevent the elderly running away with money and declaring themselves insolvent with investors getting nothing? Well, basically, these investments start off with government contracts. If the funding basically goes directly into the Elderly Group 2019 limited account, they provide audited accounts. In fact, they have a very detailed due diligence folder, which we can share with any of you that would like it. Within the due diligence folder, they give a complete asset schedule, or a schedule of all of their developments, what the valuation of those contracts are in terms of the land contract, the construction contract, and the NGDV valuation. Within that due diligence pack, they also provide a breakdown of their financials. These are based on audited accounts, and they break down in detail where the funds are being used for as well. So it'd be very difficult for them to run away. These are audit accounts, and you've got physical assets where they have value, which are tangible real assets, which I've gone to visit in the UK. So have previous funds tranches matured? Yes. So Series 1 is fully matured, and the vast majority of Series 2 has also matured as well. What if they can't raise the full 20 million? Well, the minimum raise they need to trigger is £100,000. They've never had any issue with that, and I would imagine, having just launched it, they've probably far exceeded that already. Then they will not complete development of housing. So not necessarily. So they've already got funding. They have a pipeline. Again, you can see the financials in the due diligence report. the ability to raise the funds just helps them acquire more sites. They use the funds from the bonds to help get the project started. It's just a small portion of the money they needed, because the majority of the funding to be building these developments is from the government, who basically effectively pay them for the land and pay them for the construction. Okay, why the return is at a range between 10 to 14%, and why not at a certain percentage? Okay, well, the bond is structured in such a way whereby you can choose to get paid on a quarterly basis, and then the coupon payment is at a slightly lower rate. Or you could choose to get your coupon paid in one lump sum at the end of the 18-month term. So they'll pay a slightly higher rate. Depending on how much you invest, they will also provide a bonus of between 1 to 2% on top of the coupons that they'll be paying out. So that's why there's a variation. And basically, if you have a look at the term sheet, it explains how that works. Will you share with us via email the info memo, due diligence pack, etc., for assessment and evaluation? Absolutely. Do reach out to us. If all of you want it, then we can share it with all of you. It's really good information, goes into a great deal of detail. The Audley Group on a monthly basis provide a business newsletter giving updates of photos, videos of all of their developments, so you can see how the developments are progressing as well. Yes, my colleague has just asked, if you do require information, if you don't mind sharing an email address, because some of you have tuned in and you may not have registered. It may be that you got passed on the link from a friend or somebody else, and we may not have your email address. So if you don't mind just sharing your email address with us, we can then obviously forward out the information to you. If the government provides the funding, like you say just now, then why do they need 20 million to fund their construction of the houses? So the 20 million that they're raising is not for the construction. The construction is paid for 100% by the government. But by raising 20 million, they can utilize that money to buy multiple sites, and the preparations and the professional fees that are required to get the project started. So I'm not going to say that this is the exact amount, but with 20 million, just say for the sake of argument, to initially purchase the land on average costs £1 million. You know, by having £20 million, they could go out and acquire 20 sites. If they had £3 million, they might only be able to acquire 3 sites. Now, bear in mind that those sites that they acquire will get purchased and bought by the local authority, but they do need that cash flow up front to get the project started. So I hope that does answer your question. Who is the auditor? I will have to double check on that, but I can definitely find that out for you. One of the big 4, again, I can find that out for you. I mean, you know, they are, you know, now with a total combined gross domestic pipeline of both their private sector properties as well as their social housing is over £1 billion. So I would certainly think it's probably one of the big 4. Okay, just acquiring and preparing the site will take 18 months. Where is the cash to pay back coupon and principal? Very good question. So yeah, typically the sites, they're usually development sites of between about 20 to 50 units, and the overall cycle does take around about 18 months plus or minus a few months. So basically what's happening is the developer makes profits at different milestones. They make a profit when they sell the land to local authority, so that gives them some positive cash flow. As soon as they start the construction phase, I mentioned earlier that their model means that they will be billing the local authority every month the cost of the build plus a 30% profit margin. So from a cash flow point of view, they're very cash flow positive, which may not be the case with a private developer who's relying on selling those units. And if the market is slow, then their cash flow may be very tight. And at the end of the project, the final purchase price is agreed and additional profits will be made there. So at different milestones, they're making profit all the way through. Okay, let me just check I haven't missed any questions. Sean, so the money is not for construction of the sites, but to buy more sites and land, as all the construction is funded by the government, correct? Does the government also pay for the land or sites too? Yes, it does eventually. Basically, the developer buys the sites initially, but then typically within about 3 to 6 months, those land sites are then bought by the local authority with a small profit margin. Some great detailed questions. So thank you for those of you who stayed on to answer, or rather ask those questions. For those of you who are still on, hopefully you can still see my last slide with my contact details. I would be very much delighted to reach out and meet you. Obviously, I'm based here in Singapore, but I do travel around the region, and I hope that we have an opportunity to meet up and I can address your questions face to face. It's really the best way to build a relationship. So I do encourage you. And again, if for any reason this particular investment isn't the kind of investment for you, as I mentioned at the beginning, I have a wide variety of real estate related investments. And if you are looking for real estate as part of your overall investment portfolio, then I'm very confident I'll have something for you. So again, thank you very much for joining. I'll just stay on the call for about 1 more minute so that you can ask any last minute questions. But if not, then, you know, I think another question has come in. You can see, Jess, thanks for sharing my email address. Do let us know if you'd like some of the additional due diligence package and information. Okay, we do have another question for those of you who want to stay on. Since the UK government is so vested in such projects, buying the land later, pay for the construction cost, why not also provide a loan to the developer to buy land instead of letting the company looking for financing elsewhere? That's a good question. I haven't been asked that one before. Let me just think that through for a moment. So why doesn't the government lend? That's a very good question. I think I'm going to ask the Audley Group that one. I mean, yeah, I mean, yeah, I'm just trying to think that through, and it's almost like lending the developer before they've even found the site. Yeah, I don't know the answer to that one. I actually don't know. I'll see if I can find out. So we don't know your name. If you don't mind, it says bit.me, but if we know your name and contact details, I'll be delighted to see if I can find the answer for that one. Lovely. Thank you for sharing your email address there. Okay, it's 9:14, so we have overrun a bit, but there've been some very good detailed questions coming in. So I appreciate those of you who've stayed on and asked those questions. I'll just hang on for another 1 minute on the call. And again, if there are any other questions, I'll be delighted to help. Okay, I think we'll wrap up. Thank you again for your time tonight, and taking out precious time from your schedule. I hope that it was a seminar that gave you some insight to a very interesting asset class. And as I mentioned before, this is really an opportunity to share this investment, but I really encourage you, and I'd be delighted to reach out, have a phone call, have a Zoom or a virtual meeting, or better still, have a face-to-face meeting so I can get to know you better and see how I can help with your real estate investment goals. So thank you very much and good night.